Hi, everybody. This is Kevin Gormley, CFO of Leading Edge Financial Planning, and I wanted to do a video on the election of 2016. What happened this past Tuesday. It's Friday the 11th, and I'm not going to get into politics. I'm not going to get into if this is good, bad from a political standpoint because everybody has their views. What I wanted to talk about is the financial planning and investment perspective here and the learnings that I think we should all take from this election. The first thing is that watching the election on Tuesday night, I did watch some of it until about midnight, and market futures were down big. Okay, so the Dow Industrial Futures were down 800 points. Now, Dow Jones Industrial Average is only 30 companies, but the S&P 500 futures were also probably down pretty big. I don't know what the percentage would have been, but anyway, that's not the point. The point is that people, while watching the election, traders said, I want to get out of stocks, or I want to think that the stock market is going down. So they use these futures to try to get those positions. Now the market is open from 9:30 to 4 every day, the stock market. So futures can be purchased all hours of the day, and you can buy and sell stocks in very illiquid markets. I would never do it after 4 until the next day. But this wasn't the stock market being open. This was very narrowly traded, thinly traded investment vehicles. So anyway, I went to bed at midnight, and quite frankly, I was a little concerned that the next day was going to be a rotten day. A number of people text me. Some people joked, hey, we should go to gold, or we should have gone to gold yesterday. Some people said, how does this, sincerely, how does this affect my portfolio? Some people said, hey, this might be a great buying opportunity, which I like that kind of thought process. If you're an accumulator, when markets go down, it's time to buy. But anyway, what happened on Wednesday was the market screamed higher, and again on Thursday. Now, when I say the market, the stock markets, now there was a market crash this week that I'm going to now discuss. But before I get to it, let me just say that Charlie and I, again, we are short-term agnostic. We don't believe these day-to-day gyrations should really affect our financial lives. We do know crashes are coming. There's a bunch of predictions here about crashes that are coming. We see these every week, every month, every year. We've heard these predictions for the last 8 years now. Will there be another a crash or a correction? Yes, there absolutely will be. But we need to set up our portfolios that we have enough equities that when equity markets go up, we feel good, and we have enough bonds and cash that when markets crash, we still, I'm not going to say we feel good, but we don't feel so miserable that we want to panic out. So, and we're happy to help you find that. But again, this one day, how would this one day have affected us? How would this one event affected us? It probably, again, the market could crash now, and then you can say, well, you should have done something, Kevin and Charlie, but that's not how we live our lives. We just can't invest and live our lives on these day-to-day roller coasters. They make us miserable, and I'm going to show you some data that shows that, again, we want asset classes for the long run. If you're investing in asset classes that you want really big returns, but you don't want any short-term crashes, you're doing the wrong thing. You're investing in the wrong classes. You're investing money that you might need tomorrow in investments that could go down a lot, and that's the wrong thing to do. You need to be patient for 5 to 10 years with these types of investments and not judge them day to day. But anyway, that just sounded like I was sitting up on the mountain and telling everyone what to do, and I didn't mean that to come out that way. So let me show you, first of all, bonds. And I'm not going to say they had a crash, but there's a little bit of a panic in bonds right now, okay, this week. And the reason for that is that Trump won. The Fed is supposed to raise interest rates 0.25% next week, or next month, I should say, in December. And therefore, interest rate sensitive vehicles all have been down this week, and I'm going to show you that. I think this is another great learning opportunity. The two things that we believe fixed income should give you the returns and should cause the volatility in returns and how much money you should make on fixed income The first is the credit quality. So what's credit quality mean? Well, in this case, this is the aggregate fund. It used to be called the Lehman Fund. Now it's the Barclays Index. It's a bond index of many, many bonds. So it has a credit quality of A. Now, AAA is the highest. A is pretty doggone good. And when we look at the bonds that make up this asset class, this index, 85.36% are investment grade bonds. Investment grade bonds. So these are bonds that, a lot of them are treasury bonds. We just don't expect that they'll default. So if you have really good credit quality in your bonds, you get paid less interest. The second issue is how long do you loan the money for? So when we buy treasury bonds, we're loaning money to the U.S. government. How many years is it for? Now, why is this so important? This is critical because if you have a really long duration, like 30 years in bonds, if interest rates rise up 1%, your portfolio will be down somewhere around, your bond portfolio, if it's 30 years, will be down 30% in the short term. I know, it's incredible. The shorter you have a duration, the less it will be down when interest rates rise, because you have your bonds, but all these new bonds are coming out with higher interest rates, and people want the higher interest rates. So this aggregate bond fund has a 5.41 years. So after 5.41 years, in essence, this is simplifying it, but you're going to have all new bonds, okay? That's how long the duration is. So if interest rates rise 1%, in the very short run, your bond fund will be down about 5%. Now, you're going to be getting higher interest payments. So if using that kind of math, if interest rates rise 1/4 of 1%, which we think in December, then it might be down about 1%. 1.25%. And in the last week, bond funds have been down 1.57%. No reason to panic. Okay, so this is real estate investment trusts, or REITs. Okay, they are an interest rate sensitive vehicle. Now, I think there's just panic in REITs right now. Over the last 3 months, this is the Vanguard REIT. It's down 13% over the last 13.5% over the last 3 months. I mean, I don't know that for sure, but REITs have really crashed because people think the interest rate rises are coming, and they have to borrow money for real estate. But there's been a lot of data published that in rising rates, rising rate environments, many times REITs still do very well. Why is that? Well, if inflation is going up, then people can raise the rent. They can raise the rent when inflation is going up. And so if inflation does come, and that's what causes the Fed to raise rates, then REITs can typically raise rent, and it's over periods of time. So REITs have done pretty fantastic. Over the last 10 years, they've had a return of 6.36. Over the last 5 years, they've had a return of a 7% per year. And you can see 2014 was phenomenal. 15, they had a positive return, and 16 now is basically flat. But again, these short-term gyrations, you shouldn't all of a sudden think, hey, I think REITs are terrible. No, I wouldn't believe that. I mean, yeah, maybe REITs will go down a little when interest rates rise, but probably, and they have to pass along 90% of their income back to us as investors. So let me show you the next asset class. So this is utilities, okay, and this is the Vanguard Utility Index. It's a proxy for utilities, very broad index. It's let's see here. Let's go over to asset class, and it's just going to show you large, mid, and small cap, and these are all utility companies. Now, why are utility companies interest rate sensitive? Well, they're a regulated industry. They pay a certain dividend, and so therefore people use them to get income. Okay, look at the crash. It went from, and my picture's in the way here, I think it's about 4%. Down to negative 2.4%. So they've crashed over the last week. Again, are they terrible investments now? I don't think so, but they are. They were up at one time 24% this year, and now they're still up 10%. So if you bought them near the high, you probably are a little bit upset. They've had a really very good return over the last 10 years, 9.25%. Past doesn't predict future, as we know. Let me show you just a couple more. These are foreign bonds, and not to get too much into the weeds, but the bond style here is again A, and the duration is 8 years, and that's probably the reason why this Vanguard Total International Bond Index is down again 1.5%. High yield bonds, which HYG is probably the best proxy for high yield bonds. It's the iShares index, and it's a ETF. So the credit quality here is below investment grade, which is B. So when we look at how creditworthy are these, and these companies that we're loaning to, they're not very creditworthy, and that's why you get paid 5-6% of interest payments annually. But the duration is really low. So if interest rates rise, these don't get hurt that much from an interest rate sensitivity perspective. So why are they down so much? Well, I think again that as really quality bonds come up in interest payments, as muni bonds come up as interest payments come up, I should say, people want to get out of the junk and they want to get into the good stuff that pays them. And the 10-year bond has gone over 2% now as far as a yield, so 2% payments a year. Muni bonds have crashed as well this week. Relatively, they've crashed this week. And so I think there's going to be opportunities again, and this is the MUB iShares National Muni Bond Index. When I say crashed, I mean 1.64 is a pretty big move for muni bonds. But again, I think there's going to be opportunities again in all these interest rate sensitive places. So 3 things to tell you. Number one, when markets crash, sometimes they don't actually crash. We know it's going to crash tomorrow, and it doesn't actually happen. And that's why we need to stay calm and continue to invest on. The second thing is we need to have our portfolio in a way where we don't really have to worry so much if markets go down. We need to have an aggressive enough portfolio to get the returns we need for our retirement and our life, but we don't need to take so much aggressiveness in our portfolio that when markets crash, we get really, really depressed and want to quit. And then the third thing is there was a slight crash this week in interest rate sensitive vehicles such as REITs, such as utilities, such as bonds, such as preferred stock, which preferred stock was actually down, I think, 4 to 5% this week. But it's not a reason to just throw those classes out. There's always things that are doing well and doing poorly based on what people think. And in the short run, it's pretty meaningless. So thanks so much for watching. I'm Kevin Gormley, CFO of Leading Edge Financial Planning. We appreciate the opportunity to work with you. We believe that always there's going to be a bright tomorrow with markets. Again, you just have to stick with it and stay calm and continue to get the returns over long periods of time. Thanks for watching.